You're going to see a fall in GDP and an increase in unemployment in Western countries that you've not seen since the Great Depression, and possibly even bigger. The bank is a bit like King Midas. So everything Midas touched turned to gold. Everything the Bank of England buys turns to money. Either Europe is going to come together as a fiscal entity, they're going to recognize that they have shared responsibilities and burdens with each country, or the whole thing's going to fall apart. You're seeing a fundamental realignment of world economics and world politics. We've seen nothing like this since the 14th century.
So is there anything that you think is missing from government artillery at the moment?
Yes, and it's something that I've been pushing for now since at least 2010.
Welcome back to Spicy Takes. I hope everyone's enjoying isolation as much as possible. I just wanted to hop in here before we start the show by saying that the audio is a little bit choppy at times, and I want to try and beg you to persevere through, because about halfway in we start to get a lot better audio and the conversation really picks up in terms of the audio quality. But that is not to say that the quality of what is being said is not fantastic throughout. It absolutely is. Hopefully we will ask some questions that you guys have been thinking and ask some that maybe you weren't. So without further ado, we'll get into the show. Hello, welcome back to another episode of Spicy Takes. Now, a lot of us rightly have been talking a lot about public health policy recently, and a lot of people as well have been discussing the politics of the coronavirus. But at Spicy Takes, we don't think that people have really been focusing on the macroeconomic picture enough, and that is why we are absolutely delighted to be joined by Professor Roger Farmer. Roger is a professor of economics at Warwick University. He's also an emeritus professor at the University of California, and I believe is also the research director at the National Institute of Economic and Social Research, or NISA as it's known in the sort of policy wonk sphere. And Roger's also the author of multiple books, including Prosperity for All, How to Prevent Financial Crises. Roger, welcome to the show.
Kind you. I'm glad to be here.
A nice background as well. You had a very good bookshelf that I was waiting to muse on, but you've even kind of outdone that with your.
You're out my back window right now.
Yeah,
unfortunately, you can't actually.
Fantastic.
Yeah, you've got to look from the inside now, I guess. So.
Yeah, and you're based in LA as well. So how's everything out there with regards to the crisis? Does it feel sort of a world away from the UK?
Pretty much the same as it is all over the world right now. Everybody is locked indoors and walking out once a week or once a day. So not much to report there.
Yeah. All right. Well, the reason that we wanted you on was just trying to unpack some of the key economic questions for our audience who are obviously quite interested in these things. So firstly, before we get into the coronavirus, I wanted to ask, what sort of work are you looking into at the moment, and how did you arrive at this particular area of research?
Looking at financial stability for a long time now. I started thinking about that, I suppose, 30, 40 years ago. What I've concentrated on for much of the time I've been an economist is the connection between psychology and economics. So I wrote a book a long time ago called The Macroeconomics of Self-Fulfilling Prophecies, which is all about how confidence interacts with the real economy. And I think that that's a particularly relevant topic in the current situation.
Mm-hmm. All right. Yeah, fantastic. And I'm sure that's something that we'll kind of get stuck into with regards to some of the kind of fear driving markets later on. But firstly, I wanted to get back to some of the broader questions. And one of the big things a lot of us are going to be thinking about is the oncoming recession. And what I wanted to ask is, what do you think the depth of this recession will be like? There are a couple of outcomes that people talk about. People talk about the V-shaped one with GDP growth, where there's a sort of a sharp drop, but then a very quick return through a rapid government response. There's also the idea of the U-shaped kind of curve as well, in terms of a slower, slightly deeper recession, and also maybe a W-shaped one, as in when we start to get growth and then things will drop back again once we have to put more restrictions in, once maybe there's a second return of the virus. Have you got any thoughts on how things might play out there?
So let me talk first of all about the magnitude. So you're going to see a fall in GDP and an increase in unemployment in Western countries that you've not seen since the Great Depression, and possibly even bigger. So Jim Bullard, who's the president of the employment rate of over 30% next month or the next quarter in the US. And to put that in perspective, the unemployment rate never went above 24% in the depth of the Great Depression. So it will be very, very big and very pervasive. Now, the interesting question, of course, is whether we come out of it quick, whether the social distancing that's happening is going to cause permanent job losses that don't come back for a long time, and that's anybody's guess. My own personal view is I think a fast V-shaped recovery is not very likely, unfortunately, but we'll see.
And with that in mind, how do you think this compares to 2008 in terms of the general sort of environment that we're in? I mean, you've said already that this is going to be far greater than potentially anything that we've ever faced before, at least in the past century. So in terms of the kind of economic environment we're in, but also the kind of recession it is, how does it differ to the most recent financial crisis, which will be in the back of a lot of our minds?
First of all, the encouraging sign is that the government response in most Western economies has been absolutely enormous. It's important to realize that this is not your run-of-the-mill recession. This is an engineered shutdown of the economy in response to a public health crisis. We're asking these people to stop working in order so that the rest of us can survive in many cases. The danger is, and this has been recognized both by the Chancellor in the UK and by the Trump administration in the US, the danger is that once people are laid off, those jobs disappear permanently. And you should think about a job as a relationship between an employer and an employee and a firm. And those relationships can take years to build up. And if they're destroyed, the firm goes out of business or the person wanders off somewhere else, then the effects can be very long lasting. I think what's happening is we're copying, a lot of the Western countries now are copying what Germany did in the financial crisis, which was, they were a lot more successful in the great financial crisis than we were. And they were more successful because their policy encouraged firms to maintain relationships with their workers. And as a consequence, a lot of workers were held on. We've been following that playbook. So if you look, for example, that's part of what the Chancellor in the UK has been doing. It's part of what the Treasury plan is in the US. So for example, in the US, today, the banks started making loans to small businesses, and those loans will be forgiven at the end of the crisis if I think it's over 75% of them are used to pay employee salaries. So we're doing the right things, but we've never been in a situation like this, I'd say, not just in the last century. I'd say what we're seeing now is closer to the Black Death in the 14th century than it is to anything we've seen in modern history.
It certainly is a precipitous fall in both output, I guess, and employment. But just touching on your recent blog post, it was titled Contagion, and we'll link it down below for anyone who wants to read it. It's very interesting. You say that stock markets are not simply driven by fundamentals such as disruptions in supply chains, but rather the corollary fear that is a result of these disruptions. And despite, as you've mentioned, the, I guess, unprecedented stimulus programs by the Federal Reserve, the ECB, the Bank of England, we still haven't really seen we've seen that they've failed to really shore up markets. There's been around a 30% drop since the mid-February high, and it hasn't really returned. It's still around the 25% of that figure, of 75% of that figure. So what would you say is the reason why this has failed to kind of assuage the concerns of the market? And what are the ramifications of these stock price depreciations for the wider economy?
The stock market is a claim on future resources. It's when you buy an asset, any asset, particularly a stock, what you're buying is some dividends in the future. Now, so the stock market has rightly gone down because people realize that if a third of the country is shut down, then not only are people going to be unemployed, but there are going to be fewer dividends paid in return to those stocks, and some companies will be going out of business. So it's entirely rational for the stock market to drop. But there's a two-way feedback between the stock market and the real economy, and not all of the movements you see in the stock market are simply reacting to future fundamental events. So a very good example is if you think about the real depth of the great financial crisis, which was the collapse of Lehman Brothers in 2008, September of 2008. And when that happened, the market dropped dramatically. Now, I think it's very hard to see the fall in the value of Lehman Brothers as connected to some fundamental big real event that was about to happen. Instead, what happened is the drop in the value led to a destruction in confidence. It destroyed wealth. And when paper wealth fell, people stopped buying things. And when people stopped buying things, firms laid off workers. And when workers were laid off, the drop became self-fulfilling. And so the stock market does move in response to fundamentals, but it also moves in response to overreaction to fundamentals. And the danger is that it will stay down even when the economy begins to come out of lockdown, and that I think is a particular concern. You are now, so I talked about the fiscal impact of the measures that are being taken, and so the way to think about this is when we talk about fiscal policies in economics, we're talking about the amount that the government spends in any year over and above what it takes in taxes. And most countries in Europe and in the Western world run deficits like that every year of around anywhere from 1 to 3 or 4% of GDP, sometimes even higher. And that's highly sustainable. When the government borrows, a chunk of that borrowing is turned into money when it's bought by the central bank, by the Bank of England in the UK. One of the big questions about how we come out of this crisis is going to be related to how the deficits that we're now running, 10, 15% or more of GDP, those are going to be financed. And my own recommendation would be that most of them should be converted into money.
You just touched there on some of the potential policy responses, and what can we do, not just from a fiscal perspective, but what should we expect as a monetary response as well in order to deal with some of the potential problems? People have been throwing around ideas of UBI and particular forms of monetary financing as well. So is there anything that you think is missing from government artillery at the moment?
Yes, and it's something that I've been pushing for now since at least 2010. So along with once you recognize that a lot of the movements in the stock market are non-fundamental in the normal sense, they're generated by what Keynes called animal spirits, you realize that there's a potential role for policy to stabilize those movements. So in normal times, the Bank of England operates monetary policy by moving around the interest rate. And I think there's still a role for that. But now, when interest rates are rock bottom, there's no further room to lower them for monetary stimulus. And so the Bank of England, the Fed, the ECB, they've all been buying, they've all been doing things that go under the rubric of quantitative or qualitative easing. And what that means is that in normal times, the bank will operate its monetary policy by buying very safe short-term government gilts. What they're now doing is buying much riskier long bonds and lending to companies. And what I think is missing from the mix, and I hope will become permanent, is for the bank to, in conjunction with the Treasury, to start buying the stock market. There have been precedents for this in central banks in the past. Japan has done it for a while. In the Asian financial crisis 20 years ago or more, the Hong Kong Monetary Authority bought a large stake in the stock market and made a lot of money as a consequence. And now, in my view, would be exactly the right time for the Treasury / Bank of England to invest money in equities. And the way that I suggested this happens is that the bank doesn't buy individual stocks, but buys an index fund over the stock market, value weighted. And then once they have a chunk of that, they start doing what they do to interest rates, but to asset prices. For example, you might start with a relatively small amount and then announce. So imagine that the market's fallen by 30%, and you're worried that it might fall. For example, in 1929, the market fell by 80% of its previous value, and that could still happen. So the first thing to do is make sure that doesn't happen by announcing that you're going to put a floor on the market and buy whatever it takes to stop that happening. And a second, more interventionist and I think more appropriate policy would be to announce what you're willing to pay for this index fund in the stock market over the next month. So if the market drops by 40% and you think it should only have gone down 20%, imagine it's trading initially at 100, then suddenly it's trading at 60, and the bank steps in and says, no, as of Thursday, we're willing to buy assets so that it's 80. Now, what that does is it causes private agents to buy up the assets first in order to get there before the bank steps in, so the bank may not even have to do anything. And it automatically recapitalizes the companies that are now in trouble because they have debts but no equity. So the issue with a lot of small and medium businesses and also large companies is that what is a liquidity crisis for them at the moment, because they have no revenues coming in, turns into an insolvency crisis. They go bust, they go bankrupt, and they fire their workers. And it's imperative that we stop that happening, because that's what would turn this crisis into a long-term L-shaped recession instead of a V-shape. We want to rebound, and we want to rebound quickly. And the way to do that is to pump lots of money into the economy right now and make sure nobody goes insolvent.
I think I read some of that in your work, and it was very nice to hear you explain it first person. But so after touching on the kind of monetary side, a lot of people have been asking the question that since the financial crisis, the European Fiscal Compact, which restricts deficits and the debts, or the public debts to GDP ratio of Eurozone states, has basically been failed to be lifted for states such as the Greeks or the Italians, when many of those were suffering destitution. And as well as this, Trump in recent history has favoured corporate tax cuts, and the idea of Boris Johnson spending 300 billion of extra spend on public spending would have seemed preposterous only 3 months ago. So I think many people are asking, to put it simply, where is all this money coming from? And I think you touched a little bit how it would be financed. But if the central bank fails to finance this debt, would it necessitate another round of austerity?
I hope not. So where's it coming from? Well, the UK and the US are very different from Europe. The UK and the US have a sovereign currency. And the answer is, where's the money coming from? They print it. And again, so when the government borrows money, the bank is a bit like King Midas. So everything Midas touched turned to gold. Everything the Bank of England buys turns to money. One thing to understand is that we live in a very different world from the 1920s. In the 1920s and 30s, the world was on the gold standard. And what that meant was that the currencies issued by sovereign governments, by the UK, for example, were tied to gold. That's no longer true. So the pound sterling is, I think it's still true that a pound banknote says on it, I promise to pay the bearer on demand the sum of £1. If you go into the Bank of England and you give them a pound bank, I don't think a banknote exists anymore, a £5 note, and you ask for to convert it, they'll just simply give you the same thing back, or 5 coins. So money now is not connected to anything real in that sense. This comes back to this question of inflation. So you might say, well, why don't we just give everybody lots of money all the time, and why worry about it? And the answer there is that in normal times, if you were to simply print money and give it to everybody, and people stopped working because they were simply being paid money, all you would do is generate massive inflation. And that's happened in many countries around the world. Argentina has periodic hyperinflations. Israel's had hyperinflations recently. Zimbabwe, I mentioned earlier, had a massive hyperinflation. And these are all countries that try to run run the public finances by simply printing money. There is, however, a big difference between trying to do that permanently and doing it in times of crisis, when if the Treasury prints a lot of money now and gives it to people who are in trouble to enable them to pay bills, that's basically a redistribution from the rest of us to the people who get the money. And it's the kind of redistribution that we should all be in favor of. Again, because we're asking these people to stop working for the benefit of everybody. So that in a nutshell.
Can I just chip
you mentioned Europe
very quickly?
Let me just say one more thing about Europe. So Europe's different because, and I would say this is crunch time for the European project. One or two things is going to happen at the end of this. Either Europe is going to come together as a fiscal entity. They're going to recognize that they have shared responsibilities and burdens with each country, or the whole thing's going to fall apart. And I'm not optimistic about the possibility of Europe staying together, but I hope for their sake that they manage it.
Right out of my, I was going to ask about the future of the Eurozone and the European project. So,
every major,
I'd like to hear more.
Every major currency union, so take the United States, large countries, Canada, they only survive through fiscal transfers. Take Canada, for example. There are massive interprovincial transfers into Quebec, out of Ontario, out of Alberta, and people are happy to do that to keep the country together. The only way that Europe will survive as a project is if people in the richer regions in the north are willing to live with those transfers to the south on a permanent basis. And that requires a much more centralized fiscal operation. And the founders of the European project were aware of that. But the people, most of the populaces in Europe, I think, have never been quite willing to go along with that. And that's why you saw
So
the
that's
UK withdrawing.
so that sounds like Corona bonds is a potential policy that you would
Really.
be in support of.
Well, that's absolutely essential to hold Europe together. Yeah.
All right. Okay. Well, well, that's brilliant that you managed to kind of you took the words out of my mouth there. It was fantastic. And just on the final thing, thinking about the kind of the global picture, something that's obviously going to be fascinating in the fallout when considering this is China, and not just the geopolitical relationship between them and the rest of the United States, but also how they come out of the crisis from perspective of actually not being able to grow. I think their growth was something like 9.8% coming out of the previous 2008 crash. And this time it's something, well, we'll see what it's going to be like, but it's definitely not going to be anywhere near their normal rate of growth. So what do you think the Chinese situation is going to look like kind of a couple of years down the road?
Let me rephrase that. What's the world going to look like? You're seeing a fundamental realignment of world economics and world politics. We've seen nothing like this since the 14th century. I mean, I would be very surprised if a lot of the trends that were happening beforehand are not accelerated and or cemented. Anybody making predictions here is on very thin ice because there are so many possibilities that could open up. I think that you're going to see an end, at least temporarily, if not permanently, to the globalization project that's been going on in the last couple of decades. There are huge calls now in the US to bring a lot more manufacturing, particularly in what are deemed strategic industries, back to the US. And the US is large enough to be able to do that. The UK, not so much. So an example of that is drug manufacturing. People are realizing that almost all of the drugs we need right now are being manufactured in China.
I think it's 97% of the US ones.
And the
US ones.
And the possibility that pulling out of this, China may become much more of a. I think you may see something developing which is much closer to the Cold War with the Soviet Union, as opposed to the sort of warm trade relationships that we've had for a couple of decades now. There's certainly a realignment in global politics. That China is going to become a much bigger player, and I suspect that there'll be a three-way balance between Europe, the US, and Russia. But I'm not a political scientist, so these are broad guesses. Certainly expect to see a lot of manufacturing being brought back to the UK, to the US, a complete realignment of global supply chains. Now, on top of that, you've got the fact that people have suddenly realized that it's possible to buy things online. I don't think that's going away. I think that the local high street, going out to buy things in shops, that's over. Amazon-like entities are going to be producing everything. Relationships that productive relationships that can happen online, like the interview I'm having with you now, will become much more common. You'll see, I think, education moving online much more. A lot of businesses that don't actually manufacture things but require contact between people will happen virtually. I would imagine a big boost in the technology for that. So imagine 3D chat rooms coming soon, where you'll be sitting in a room and someone's sitting you think they're sitting in the same room, but they're actually in China. That's in our future and not too far away. So I think when we look back at this, it will be a huge turning point in the world that we inhabit.
Wow, there's a lot of great points there, and there's so much to unpack. But I think I think we should, given the internet, and we don't want to take up too much of your time, so I think we could wrap up there perhaps. But we really appreciate you giving up your time to us, and appreciate you coping with the rather poor internet for us.
Yeah, it's a pleasure. I'm sorry that the internet is so bad.
No, it's all right. It's all right. No, it's just the sheer amount of Netflix being watched right now.
I gotta
What can we do about
go
it?
take a swim right now.
Yeah, you got the setting
Sorry?
for it.
Yeah, you're one bit a day, I'm sure.